Hello, traders and investors. Todd Gordon, founder of Inside Edge Capital. This is going to be the market update for the week of November 6th, 2023. And what a week we had. This is very interesting here. Lots to talk about. I think a really good report that I'm looking forward to sharing with you. And speaking to investors of Inside Edge Capital and potential investors, but this should help everyone in terms of the way we're looking at the markets and all the different forces that are impacting and influencing the stock market. So hopefully we can shed some light on those and give you an idea of what we see and what we see going forward. So let's go. I'll kind of knock this back a little bit. My daughter, Eden, she's 5. She said, "Daddy, vacuum your beard off. I don't like it." I said, "Okay." So I did it for her. And then my wife's like, "Todd, you look so ugly without it." So I can't keep the girls happy. So whatever. A little bit more professional, I think, without the beard. But anyways, let's go. Week of November 6th, 2023, Inside Edge Capital Market Update. Okay, there's the disclosures. Certainly have a look. If you have any questions about the information we are presenting, I really encourage you to look through those. Okay, as we mentioned last week, the new website is live, insideedgecapital.com. More reflects our brand, our identity, the way we approach investing and financial planning, and we certainly tried to inject some personality and some life into the wealth management business, because that's how we approach this. And it's still a work in progress, and we will be adding weekly content to this to the website. This is one piece, and Kyle's got a bunch ready to go for you in terms of financial planning, which is really key for me. We are active management, especially in this kind of market. I can't imagine not being active management. But in terms of financial planning, the way we run portfolios and the way we recommend a mix for you is only if we first really know who you are and what your tolerance for risk is and what your goal for this money is longer term, and what's the timeline in which you want to meet these goals. That's really, really important for you and us to understand, because then you can truly conceptualize how much risk you want to take. Which more risk, the more reward is the way it goes. So really important that financial planning happens first, and then only then can we back into a good portfolio mix of the 5 portfolios that we offer to get you headed in the direction that you want to go. So planning is really important, especially in an actively managed firm like ours. Okay. So here's what we're going to cover today. There was the last slide there, just talking about the new website being live. Okay. So here's what we're going to cover today. Investor sentiment, very, very, pretty extreme sentiment shifts going back and forth here. Mostly bearish. We had a very interesting reversal week that we'll talk about. We'll talk about interest rates that are driving everything. We'll talk about third quarter earnings, which we're now 80% through. We're going to talk about technical support in the market, and we are updating the portfolios. We're rebalancing and reallocating portfolios this week. There are some pretty significant changes to come. Investors of Inside Edge, you will, along with this report, not today, but this week, you will receive a breakdown of the holdings and changes we've made for all the different the models that we have, and you'll be able to see what each portfolio is comprised of and changes that we've made. So you'll receive that if you are an investor. Okay, but we are doing some pretty significant changes to the portfolios because the market requires it. All right. So markets recovered very, very sharply last week. The Dow was up 5%. The S&P was up 5.85, and the NASDAQ up 6.6, the best since October and November of exactly a year ago. What caused that move? We'll talk about it at length. Here is the technical position, looking at a chart of the S&P 500. Going back, each bar represents 1 week, and there's the COVID lows, 2020 lows, and we've rallied quite sharply up into the very end of 21, beginning of 22, which this was a year that many would like to forget, into the lows that were set exactly a year ago. And we've rallied smartly back up to 4,607 S&P, and here we trade at 4,363. We are in consolidation right now. We have a pattern where the highs are getting lower and the lows are getting higher. We are going to be sort of squeezed inside of this zone, which builds up potential energy, and then it is released and it turns into kinetic energy. Right, so we are pretty tight, and if you square that up with a very bearish sentiment for a lot of macro economic and obviously wartime tensions and macro factors we'll talk about, it's pretty surprising considering how close we are to the all-time highs in the market. We are above the 50-day moving average, which is there in orange, and the 200-day moving average is just below. So this was last week's reversal, which was quite sharp. So investor cash and investors are sitting on the sidelines in this very highly pessimistic market, which if you read the headlines, you focus on them, there is a lot of reasons on the surface to be bearish. Now, once you dive in and you set the emotion aside and you look at what's actually happening rather than you think what's happening or what the traditional and social media headline makers will want you to believe, there's a difference. So I really like this this quote. Any intelligent fool can make things bigger, more complex, and more violent. It takes a touch of genius and a lot of courage, and I would insert a bit of simplicity as well to move in the opposite direction, right? And that's the way we like to think of our approach to the markets. So this was a tweet that I put out just almost a year ago, December of 2022, and it highlights some of this simplistic way we look at the market technically, which is with the Elliott wave approach. And basically, without getting too much into it, I save the nitty-gritty details of this for the research business, and I just touch upon it on the wealth management side. But generally, when you see three-wave swings, that is usually an indication that is counter to the prevailing trend, which is down. So in early 22, we had a three-wave move. In summer of 22, you had a three-wave move. And then in October, November, all of a sudden you had a five-wave move, which that suggests that the trend may be changing. And it's really as simple as that from a technical point of view. And I got a lot of hate response on Twitter for putting a bullish scenario out. And this was a good response from a follower. He said, I love that no matter the market, this is always the reaction of the faceless crowd. Bulls get no respect. They're reckless, lazy, and out of touch with reality and the facts. On the other hand, bears are hailed as being prudent, responsible, careful, and scholarly. Well, I mean, you know what happened to the market next, right? The market rallied sharply, and here we are again. We've set back since the summer of 23, and then just this week, the market's rallied very, very sharply, and sort of the same kind of thing. The bears are out in force right around here, and very little tolerance for the upside because again you're lazy and you're trend following and you're unsophisticated because basically in the media, traditional and social, and it's just human nature. It's not media's fault, but the old saying, if it bleeds, it reads. There's not much headline grabber saying, listen, everything's gonna be okay. There's a lot of people vying for attention and big scary headlines, a lot of reasons that sophisticated people sound like you want to be out of the market and you should be selling your stocks and follow me. Fear is a much easier tool to sell than saying, look, it's going to be okay. And if it's not okay, being that we're active management at Inside Edge, we can calmly make adjustments. And I'll tell you, we seriously considered making adjustments and getting protective. But I stuck to the process, and I'll show you bits and pieces of the process that we go through. And I was concerned. I had some protection ready to go if we were going to continue to break down through the 4,100 level in the S&P. But from the macro point of view, we had interest rates reversed. We had Fed policy reversed. Q3 earnings have been good. So, we had, there was not a reason from what I saw to make some pretty significant changes in the portfolio. So we stuck to our game plan. And so far, it's played out. Okay, so let's talk about that sentiment. Let's dive into that a little bit more. So this is U.S. investor bull bear sentiment. The AAII, which is an organization that puts out this survey and has for a long time, it's pretty widely followed. So what they're looking at here in purple is the spread between bullish sentiment and bearish sentiment. And we have dropped down to minus 25.97, so call it minus 26%. So that means 26% more bearish people, investors, researchers, investment advisors, a lot of people go into this. So 26% more were bearish than bullish. And if you look at this, at what point has this indicator reached a low? At what point is this oversold? Well, you can see that there were several times, 2019, 20, even during COVID, we got down to that minus 26, 27%. And that wound up being the low of the survey. And almost every time we get down there, you see significant lows in the market. Okay, and then we rallied up, and then we got to as high as 36.5%, so 36% more bulls than bears. And that started to give us an indication that we're moving to the top post-pandemic. Okay, post-pandemic reaction. And then what was interesting in 2022, as the market was dropping because interest rates were spiking, inflation was coming up to multi-decade highs, the sentiment actually got worse here than it was at the low of the COVID crisis when the economy was on the verge of being shut down. It kind of was in some ways. So sentiment was actually worse back here than it was in COVID. And then we've rallied sharply. We reached an overbought status, and we've backed off here in the summer to November decline. Now, again, minus 26%, barring that really bad 2022 reading, has basically been the low of the bull-bear spread. And this last week's reaction in the market, which was a big response to interest rates we'll talk about, is sort of confirming that the bearishness has swung too far in one direction. This same survey going back to 1990, so you're looking at over 33 years of this. What I find interesting, there's two things before we get into modern day. I look at the 1990s and the 2000 rally, and this is not the bull bear survey in terms of asking people how they feel, but actually how they're invested. And this is the AAII total stock allocation as a percent of your portfolio. So what you saw back here in 1990 when we had a recession, which is the gray shaded area, that's obviously going to be the start of the first Gulf War, 1991 area. But you look at the allocation to the stock market. Look, it was 40, 44, 48%. And then we had the tech rally into 2000. That allocation went from mid 40s all the way up to mid 70s. So you had a lot of people that are very underinvested in stocks. So that's part of the reason you had such an unbelievable run in technology. Right? Okay, and then where are we now? So now I would say we're sort of mid-range. I do believe we're going into the next tech bull run. I do believe it. I think the technology that's here started out with AR and VR over the last couple of years, and then over the last year, we've become familiar with generative AI and the impacts and the efficiencies that artificial intelligence will have on companies, and the need for companies who are well capitalized with good balance sheets to spend and invest on this to improve their efficiency is real. It spans a variety of industries and sectors. So it's real. I think it's very real. And you're going to need semiconductors and computing power and bandwidth and different technologies to support this, right? So I do think we are going into the next tech bull run. And now that we have visibility in interest rates, which I'm kind of skipping ahead, we'll talk about that in this presentation, is going to accelerate that. But what we've seen here is, okay, we're not starting at a very low point. Like we had in the early 90s, when we had 40, 45, 48% allocation equities. People are, pretty much around the 60%, 65% allocation equities. So we're not hugely underinvested, but we're low. And I think as the stock market continues to rally, you're going to start to see that break into the 68, 70, 72, maybe get back up to those highs that we saw. And of course, the market, if you look at where the NASDAQ was here when we were 64% invested up to 72, if you put this on a logarithmic scale, which is factoring in percent change, the percent gains were massive. They're in the hundreds of percentages, right? So it's a big swing for this guy to go up like it is. The other thing that I notice is look at the 3 lower highs in asset allocation in equities. We've made 2 lower highs. So after the 2000 bubble, stocks never really reached not only the all-time highs, but the percent representation in their portfolio. We only got up to 72, 71%, where in the past, we've seen 75, 76, 77% up here, right? So we're at 66%. So I think we have a good 10% to go for people to increase their allocation. And of course, at 10% doesn't sound like a lot, but when you think about the entirety of the investing universe that has allocation to the US stock market, and they were to increase their exposure by 10% to stocks, that's hundreds and hundreds and hundreds of billions of dollars, maybe even into the trillions. I don't know the number, but I have some numbers coming up here in terms of how much money is parked on the sidelines. So how much money is going to come back into the stock market once we get visibility on interest rates? Okay, and we'll come back to that here in a second. From a seasonality point of view, we had sentiment. We talked about that. We talked about where allocation and sentiment was. Let's look at historically what actually happens in the month of November. So this is looking at the bottom is the S&P 500, the average monthly performance going back from 1950 to 2023. And October right here is a good month. On average, it's up about 0.8, 0.9%, and we were hugely down. We were down like over 2% for the month. But November is the best month historically for the S&P 500. Okay, we're up over 1.7% on average, and we're already up that now. But we also have a little catch up to go because October was negative. See, it's all the way down here. That diamond is the S&P's performance for October. So normally it's up here on average, but we were down over 2%. So November is the best month of the S&P, number one. Number two, which is very much related, which is volatility. This is the volatility index, which usually when this guy is up, volatility is up, that means there's fear in the market. That usually means there's stock market underperformance. When the volatility is down, people are happy and complacent, and usually stocks are moving higher. This is the weakest month of the year for the VIX, the volatility index. So strongest month in stocks and the weakest month in terms of volatility. So we're in a seasonally very strong period. And you can see October, November, and December are the best 3 consecutive months for the S&P going back to 1950. So what we're looking at here is the S&P 500 in blue, all right? And then we have GDP, the gross domestic product, but it's real GDP, which means inflation factored in. And that's an important concept that you want to keep in mind is the level of inflation will have an impact at what your real cost to borrow is, right? If you make a loan, right? If you take on a loan and you have an 8%, stated rate, but you have to service that debt, and let's say the economy's running at 5% inflation. If you borrow at 8%, but the amount that you have to repay is being inflated away at 5%, your real cost is 3%, right? So if you're borrowing money in an inflationary economy and paying that back, inflation works for you. But if you're letting people borrow money who are paying you back, inflation is working against you because you're getting less valuable dollars coming back to repay the loan. So this concept of real is very important, especially when it comes to metrics like that and interest rates, which we'll talk about, because we haven't had inflation for a long time, right? So it's scary on the headline to say 8%, mortgage rate or 7.5% mortgage. But if the money that you're using to repay that stated coupon or that to service that debt, if your dollars are being inflated away, when you repay or service that debt, it's actually a good thing. It works with you. Okay, so just kind of keep that in mind as we talk about real and nominal. So that's GDP. Right here is the U.S. commercial bank deposit. Okay, so this is 17.34 trillion on deposit at U.S. commercial banks. That's off the high of 18.13 trillion in April 22. Not surprising considering the regional bank crisis, people pulling money out of those commercial banks. What's gone up is the orange, which is U.S. money market funds. So short-term, short-term paper, short-term deposits, making your 3, 4, 5% or more short-term deposit. So money coming out of banks, going into money markets and short-term, that just hit a new high. And this was Q2 of 23 of 5.91 trillion. Can't wait to see what the Q3 numbers are. Are they going to be above 6? Are they going to be 6.5? Are they going to be 7? How much money went into money market funds? There's a lot of money that went into short-term, which there was just an article in Barron's this morning that said that money is starting to come out and is going back into equities now that we have some visibility on interest rates. Now, this is just sort of a step back and just to say that we are stock traders. I run a research business, tradinganalysis.com, that we're focused on stock market research. I run a wealth management business. We are a predominantly an equity management registered investment advisor, and we have fixed income and hedges, option hedges, and so on and so forth. But in this kind of market, this is one that's very driven by what they call global macro. Right, so there's intermarket global macro flows from the 4 major asset classes. And the 4 major asset classes, along with equities, which is number 1, bonds, fixed income, commodities, and foreign exchange. There are different times through different market phases where sometimes 1 or 2 of these asset classes are having an impact on the other one. There are other times where just one's moving, where nothing else is moving. Let's just say stocks are going, bonds, commodities, and FX are quiet. There's other times where it's FX and rates and everything else is quiet. The last 2 years, post-pandemic, when we've had this inflationary spike, you have all 4 major asset classes really moving and impacting each other. We have inflation spiking, which drove up interest rates. Inflation spiking and interest rates has an impact on commodities because commodities are very much driven by inflation, disinflation, deflation, supply and demand, global growth, global contraction. FX is the movement of currencies between borders, and the key driver of somebody wanting to sell dollars and buy the euro is interest rate differentials. How much is the yield or the cost to borrow in Europe versus the yield or cost to borrow in the US? And that is directly determined by bonds, fixed income, interest rates. Interest rate differentials between 2 countries create foreign exchange flows. We know inflation's crushed bonds, spiked rates. We know the impact it had on crude oil. We know the US dollar was very strong, and as a result, it really hit the stock market. So this is a market over the last 2 years where all 4 major asset classes on the macro flows were really impacting each other. This is the most that I've seen since I used to trade for a hedge fund in 2008 and 2009 during the global financial crisis when all those guys were moving together. Hasn't been this busy since then. I'm wondering, and I'm kind of hoping we go into a period where FX, which is the dollar and euro and yen and Aussie and Swiss, slow down, interest rates slow down, and maybe we go into a period where it's more equity movement, maybe some commodities in there, which I think would be a good thing. That's my hope. I think that might become a reality because I don't think the macro flow can get any busier than it's been. So when I do an equity report like this and we have so much focused on interest rates, which you'll see, that's why, because interest rates in the bond market has had such an impact on the stock market. It's not always that way. And it probably will become less and less important. But as an investor or even a trader of the stock market, you have to have an idea what's going on there. All right, so here's fixed income yields and the S&P 500 going back to 2018. So in blue is the 10-year yield, and in orange is the 2-year yield, right? And remember, as bond prices go down, their corresponding yields or interest rates go up. There's a perfectly inverse relationship. I'm showing you the yield or the percent on the bond, right? So 4.67 is your 10-year yield, 4.98 is your 2-year yield. And green is the S&P 500 on the left scale. And as you can see, as the yields, both 2s and 10s, started to push up here in 2022, what happened to the stock market? Pushed down. And then as the yields started to go sideways a little bit, stock market started to recover. And then we had a brief period of time where stocks and yields trading together. Well, now we're starting to get yields to roll over a little bit. On the downside is stocks just had a really nice week last week. Here's the 10-year yield. We're looking at 60 years of your 10-year yield going back to the late 50s. So you can see how far Down yields have fallen since the 1982 high, down to the low where we almost went negative on nominal yields. But then we got the inflationary spike post-pandemic. Here is a daily chart, so a short-term look at that 10-year. We went up to 5%, and we're now down to 4.67, and that changes all the time. This is your 10s and 2s again, but I've also now included the Fed funds rate. So where the Fed gets together, every month or two, and they set their policy rate, that's the red one. Now, the 2-year, the short-term yield has the biggest impact on where the Fed sets their rates. So you can see red and blue are trading together. The black one is the 10-year yield. So that's called the long end of the interest rate curve, and the 2s is the short end, and that has an impact on where the Fed sets policy. Now you can see there's a spread, between the two. So a lot of people say wherever the 2s go, the Fed is gonna move. Not true. For the most part, red and blue trades together. But, looking over the last 14 months, look at red, the Fed funds, and look at blue, 2-year yield. You had the 2-year yield dropping from 4.8 down to 4.2, trying to convince the Fed to cut rates. Well, the Fed said, well, sorry, screw that. We're going to keep going. And then the 2-year yield dropped again in March, but the Fed said, nope, not this time. And now we're starting to get the 2-year yield roll over again. When will the Fed maybe start to drop the 5 to 5.25, actually it's 5.25, 5.5 range on the Fed funds rate? And we'll talk about that, okay? So right now, looking ahead into December, which is the next Fed meeting, there is right now a 90% chance of holding rates steady, up from 74% last week and 57% last month. So we have a 90% chance that the Fed is done raising rates in November. And you remember, what impact did increasing 2-year and short-term rates have on the stock market? Well, it hurts it, right? Increase the cost to borrow slows the economy down. Well, if the Fed is done because the view on inflation is that it's peaked, that's a really good thing. So we had a 36% chance of another hike in December. That's now down to 9.8. Last week it was 24. Now we're at 9.8. The other good news is looking out to Fed policy. The first rate cut is now in the futures market being priced in for May. Right now, there's a 58% chance that we're going to get a cut in May. That has moved up. Okay, we are right now, our current rate is 5.25 to 5.5, as it says right there and right here, target rate. And the chance for the May meeting of going down to 5 to 5.25 is 45% chance. Okay, so that is going to be right here. Oh, sorry, right here, 45. Plus, we have a 12.5% chance of going down to 2 cuts, 4.75 to 5. So you add 45.5 and 12.5, and that's going to give you your 58% chance of a cut in May. That's the first thing. The second thing is it used to be 3 cuts were being priced in next year. Now they have 4 cuts on the table, going from 5, 5.25, 4.75, 4.5, 4.25. So that's a good thing. Now, I am not of the opinion that we need to cut rates to have a healthy economy. I don't think 5% short-term interest rates is going to be enough to keep people out of the stock market. I don't think so. Some people, but I don't think those are going to be aggressive buyers. I think if the Fed wants to leave rates at 4.5, 5, 5.25, I think that's fine. And when there's a time to cut rates, when the next shoe drops, we can address that then. But don't just cut rates just because we want to sort of do an adjustment lower. I think the economy should be at 5% right now. And it seems to be that looking at these earnings, which we'll talk about, the economy's doing just fine with it. All right, so let's look at expected inflation. So we're looking at the 10-year yields, which we just talked about a whole bunch. Okay, and let's look at expected inflation. The two have been very tight in the 80s, 90s, 2000, 2010. Ever since the global financial crisis, GFC, you get a little divergence between the two. All right. Right now, what you're seeing is over the last 4 to 6 years, On the left scale is the 10-year yield. The right scale is expected inflation. The 10-year yield right now is up just below 5%, as I showed you in the last chart. The expected inflation 10 years out is 2.3%. So you got a 10-year yield at 4.7 and expected inflation at 2.3. And you can see how tight the two have traded over the last, call it, 23, 30, almost 40 something years. So there's a big divergence right now. Now, what's going on is I don't think it's inflation expectations or economic slowdown. I think what's happening is investors, both domestic and foreign, don't like our debt to GDP and deficit to GDP numbers. We can't, we have a lot of political discourse in here, and I think markets are selling bonds and creating a higher interest rate, which makes the yield that's requiring, or the yield that investors demand to hold U.S. Treasury higher, because there's more perceived risk, because there's so much bipartisanship and we can't get our fiscal house in an order. So it's the markets saying to the U.S. political system, stop acting like a bunch of buffoons and start to work together. And it's gotten very ugly out there, and markets are starting to tell and price in that we're not going to lend you money at 2-3% until you can start to get your act together and behave like adults and start to be fiscally responsible rather than spending so much money. So that's what's going on there. Okay, and that is not a political statement. That is, I'm just showing you facts. Like, inflation expectations are low, and yet our interest rates are going up because people are selling our bonds, because maybe we don't have the highest credit quality as we had, perceived credit quality we had in prior years, because look how long it took us to find a Speaker of the House, and we have impeachments happening all the time, and trying to prosecute former presidents and impeaching the current president, and we better turn it around. We're starting to act like a banana republic, I think, and markets are confirming that. So hopefully we can settle that. Okay, so let's look at this idea of the yield curve inversion, right? So this is going to be your nominal yield curve. So when you hear the yield curve is inverted, that means, the difference between the yield on the 10-year Treasury and the 2-year Treasury is negative. That means the 2-year yield is higher than the 10-year yield. So you can see that we've had negative periods. That's the red shaded area that led into inversion. Right, that led into recession. I should say the shaded areas are recession. We were pretty negative. We were about 106, 107 basis points of inversion, and we've narrowed it to 26. But then what you do is, what's more important, we talked about it earlier, is looking at the real yield curve. You look at 10-year expected inflation, as we did in the last chart, and factor that into the 10-year nominal yield. Right, so your real cost to borrow at the 10-year, and then your real cost to borrow at the 2-year. So that's the yield curve factored in for inflation. Well, this was also very, very negative, but we just went positive. The real yield curve briefly went positive. We're back negative by only 6 basis points, which is 0.06%, but we went positive after being deeply negative. What does that mean? Well, as I said here, when short-term rates are higher than long-term rates, this is referred to as yield curve inversion, and often signals economic recession. Many in the traditional and social media space assume that recessions result in bear markets in stocks. So how many times have you heard, we have yield curve inversion over the last 2 years, we're going into recession, sell your stocks? Have you heard that? I know I have. And I've had it on my list to go and do this study, and I'm really excited to share this with you. Is there any fact to that? All right, so looking at the 10-2 real yield curve, there are 11 instances where it was negative and it went positive, a lot of which happened during or immediately preceding a recession. So this one, 82, brief negative in a recession. 89, we went positive into recession, and the gray shaded areas are your recessions. Okay, 98, a couple times, 99, 2000, recession. 2006-7, global financial crisis, recession. Okay, so several times we would let into recession. If the yield curve is negative and we go into positive and it brings in recession, should you sell stocks? Well, what I did is I looked at all 11 currencies. This should be 19, sorry, that should be 1980, not 20. Let me change that real quick. 80. Okay. So every time the yield curve goes negative, we go back positive. What I did, like in February of 82, when we went back positive, I looked at the return from March of 82 to March of 83. So April of 89, when we went back positive, I went May of 89 to May of 90. The 1 year average return after the real yield curve goes back positive is 13.9%. Your max drawdown was 13.98. Your average return when it was negative, when the stock market was down following a move out of inversion, was minus 8.4%, and that happened 3 times. 8 times it happened when we went positive out of yield curve inversion and the market return was positive. The max return was 36%. The average return when it was positive was 23.5%. So you had 8 times when we led to a positive return of average of 23%, 3 times when it led to a negative return in the S&P, the average return was minus 8%. Okay, but the overall return on average over 11 times was 13.94% return. 2-year average, same thing, looking out 2 years after the month we go out of inversion. The max drawdown was 44%. Average return when it was negative was minus 38%, which is significant, but it only happened 2 times. 9 times out of 11, when we come out of yield curve inversion on the real yield curve, 9 times it was positive. The average return when it was positive was 29.79. Max return was 49%. So the 2-year average return coming out of yield curve inversion was 22.3. The 1-year return is 13.94. I think what's happening is people who are citing and saying, oh, we go into yield curve inversion, we're going into recession, sell stocks. They're suffering from something called recency bias, which is just looking at the last 2, basically. It happened in a big way in 2007, and it happened in 2000. Those are much different markets than what we're in now, okay? So those are the stats on coming out of yield curve inversion. All right, the other thing that's going on here is the housing market. Now, the 10-year yield that we've talked about so much is a key driver of the 30-year fixed mortgage rate. So you can see the correlation between the two is unbelievable. And there's also a spread between the two. You know, the 30-year mortgage is usually higher than the 10-year yield. And this is the actual spread. So you take your 30-year fixed mortgage rate, subtract it from your 10-year treasury yield. And the max difference going back to 1985 is about 3%. So right now we are significantly overbought. So 30, so what is that, 23, 33, a little bit less than 40 years. We're as overbought as we get in terms of the difference between 30-year mortgage and the 10-year yield. Mortgage rates are expensive and likely going to come down. I've seen them over 8, and they've already backed off to 7.5 or so. So we're already starting to see the spread come off. That will help the housing market. Okay, and later in this presentation, I'll show you that last week, interest rate sensitive and specifically housing and real estate, those stocks were gapping up last week because we've begun to found a high in rates. So housing was just, home builders were ripping on the upside, and we're supposed to be in a housing crisis. It's kind of funny how that works. Okay. So let's look at earnings. All right, we're in Q3 earnings. This is from FactSet. 81% of the companies have reported in Q3. Of these companies, 82% have beat their earnings per share estimates. That's above the 5-year average of 77% and above the 10-year average of 74%. Of the 81% of the S&P 500 companies reported, 82 of them have beat above EPS, earnings per share. All right. in aggregate, companies reporting earnings that are 7% above estimates, below the 5-year average 8.5, but above the 10-year average of 6.6. So companies are beating earnings expectations. Companies are also downbeat for Q4, and they're giving lower guidance, which the markets are paying attention to, but the CEOs are citing economic and macro uncertainty. We're talking about macro. Macro is high crude oil from geopolitical and international tensions, Ukraine and Israel. Interest rates, which we know, and as related, strong dollar, right? And those are all related. The dollar has come off. Interest rates have come off. That is the geopolitical, the macro uncertainty that CEOs are referring to for Q4. So why wouldn't they be in a position when they're on the conference call? Why wouldn't they, everyone's expecting them to say it's a tough macro environment, wouldn't expect much. Why wouldn't they set the bar low, under promise and over deliver in Q4? They're probably going to beat expectations again in Q4, right? So this earnings season has been very solid, and I think they're setting the bar low for next quarter, for Q4, which we could see a similar response. Look at some market internals underneath the hood of the stock market. So here's the S&P 500 in magenta. I guess that's magenta. Let's call it purple. And then this is the put to call ratio. So the amount of puts being bought, which is a bearish protection, and calls being bought, which is, a bullish expression. The ratio of put to calls, if you just put a moving average over them down here, it's very high. There's a lot more puts being bought than calls. That is indicative of a lot of fear in the market. And we got up to a pretty overbought, or the ceiling of, on average, how high the average of put to calls will get. And that corresponds with a stock market low. When put to call gets up here, you generally get a low. Put to call gets up, quite high, you get a market low. Market low, put to call high, put to call high, market low. We just made a lower low in the S&P, but actually put to call did not make a new high. So we've begun to back off. The fear is subsiding, but the moving average of put to call remains elevated, which we should have room to go down to 0.8, 0.7, and then we need to get oversold down to 0.7, 0.6. And when that happens, stocks do that. This is the amount of advancing stocks versus declining stocks on the New York Stock Exchange. So again, we're looking at a pretty significant downtrend here in the moving average of advanced decline. And what happened is the stock market's making three lower lows here, but the advanced decline is drying up, meaning the amount of stocks declining is starting to dry up. And not only that, we got to push above these two recent highs, where the S&P is not above those equivalent highs. So we had a pretty good breadth expansion right here. And that is indicating that the selling in a lot of different stocks is easing. And one of the main reasons, as I mentioned, is interest rate sensitive stocks. The 10-year Treasury yield over the last 2 weeks dropped about 3%. What are the markets that responded the most to the drop in yields? Well, they're interest rate sensitive sectors and industries. Here's the S&P 500 as a benchmark, which was up 2.8. What was up almost double that over the last 2 weeks? Small cap value stocks, utilities, real estate, home builders. Those are all interest rate sensitive sectors. Those guys had huge weeks last week as we began to get visibility on the top in interest rates. There's your real estate ETF. There's your home builders. Home builders were literally gapping up last week. They were crashing higher. And yet we're supposed to be in a housing recession, and home builders are up at the highs, gapping up multiple days in a row. There's a difference between what the headlines will want you to believe versus what's actually happening underneath the hood. Talking about, there's a lot of discussion about the small caps. So the Russell 2000, these are companies that are, 2 billion in less than market capitalization that are underperforming. Well, there's about 4,500 stocks that trade in the U.S. 2,000 of them are the IWM, which is the small cap Russell 2000 index. And there's a good amount of those that are what they call walking zombie companies. They don't make any money. They're highly leveraged. They don't have a future. And a lot of people are saying, well, we're not in a bull market because the small caps aren't performing. Yeah, but that's including the zombie companies, the walking zombie companies, the Walking Dead. Look at the CALF ETF. These are small caps, but they're the top 100 free cash flow stocks that are actually making money with positive free cash flow. They're not in a bear market. They're right on top of the SPY, which is the S&P 500 tracking stock. So yeah, the Walking Dead zombie companies, you don't want to be invested in growth and high quality value with good dividends, because however many walking zombie companies are not participating in the upside, you can have them. I don't want them. So I don't buy it. Look at that ETF, small cap companies with positive balance sheets and good free cash flow. There's no bear market there. Okay, so we have updated our sector allocations. Those of you who are in the sector portfolio, you will see new allocations. You can see the moves that we've made. We are overweight technology by 13.9 relative to the S&P at 28.1. We're at a 42% allocation. I dropped consumer discretionary 5%, but we're still 2.5% overweight. We're still not seeing the move up in consumer discretionary that I would like to see on a rotation and on an earnings basis. We're overweight communications significantly. Really, really good move in communications, which is like Google and Meta and Netflix. I adjusted up industrials. I adjusted up materials. I decreased financials. We're significantly underweight financials by 8.8%, as the S&P has a 12.8% weighting of financials. We're only at a 4. Energy, I kicked up just a little bit. We're at a 5% allocation, where the S&P is at 4.5. So we're 0.5% overweight energy. And I kicked up staples a touch, and I left everything else as is. No exposure, no adjustment in healthcare, real estate, and utilities, and we are underweight those guys quite a bit. So those are your new sector allocations, and we are, as I mentioned, we are updating all of the equity holding portfolios and the fixed income. You'll see those changes come through this week in light of the new market that I believe we're in, and we are always watching closely. We are actively managed, and I watch this every day, every hour. And we got close to making moves there over the last month, but we stuck to the process, and so far we've been rewarded. I'm watching the pullback here, and I'm thinking that we do want to continue higher with more macro clarity in terms of interest rates and commodities and FX, and we can go back to good old earnings in the stock market. All right, we'll leave it there until next week. Hope you enjoyed it, and I will talk to you guys soon. Thanks.